In this video, we'll be going over IRS Form 8995A, Qualified Business Income Deduction. So before we get into the form, there's a couple of things that you should know. There are 4 different schedules that you may need to complete. Most people don't need to complete all 4 of them, but they're schedules A, B, and C, and D. As we post updated videos to each of these schedules, we'll put the links in the show notes on where you can access them. So you may need to file Schedule A if you participate in a specified service, trade, or business that exceeds a certain threshold. So you may need to complete that form to provide additional information. Schedule B would be if you're choosing to aggregate multiple trades or businesses into a single trade for the purpose of this form. Schedule C involves loss netting and carry forwards. And then Schedule D involves special rules for patrons of agricultural or horticultural cooperatives. So you'll find more detail on which of these forms might be necessary and the order that you should complete them in our article. You can find that on our website. Simply go to teachmepersonalfinance.com, type in IRS Form 8995-A, and that article should appear. So let's go over the parts of this actual form. So there are 4 parts, I believe. So the first part, we're going to name the trade, business, or aggregation information. In part 2, we'll actually calculate the qualified business income, the adjusted QBI. Part 3 will calculate a phase-in reduction if it's required. And then part 4 will actually calculate the business income, the qualified business income deduction itself. So John Doe is reporting this on behalf of his company. We're going to start with part 1. So this would be going on at John Doe's individual tax returns. So his company, Doe Enterprises, you'll check this box in column B if it applies to you. So you would need to determine whether or not this is a specified service according to the form instructions. So basically, you'll have to determine if you're filing Schedule A, then you fall under the rules of a specified service. If you don't have to file Schedule A, then you most likely don't have a specified service. So check this if you've completed Schedule A. If not, if you completed Schedule B, then you would check this. You would also be completing Schedule B before you start this. You'll enter the taxpayer ID number. This would be the EIN of the company or business or the trade. If you don't have an EIN, you can enter your social security number or your individual taxpayer ID number. If you're a sole owner of an LLC that is considered a disregarded entity, you would still put in that EIN even if it's a pass-through entity. And then column E, you would check this if you're filing Schedule D, which is the horticultural or agricultural patron. So basically in part 1, you're just checking boxes to say, this is my company or my trade or my business or my aggregation, and here are the things you should be checking: Schedule A, Schedule B, or Schedule D. And you can put up to 3 companies in here if you need to. If you don't, we're just going to go through one company, Doe Enterprises. So now we're going to go to part 2. Part 2, in line 2, you're going to enter the qualified business income from this particular trade, business, or aggregation. So in part 1, we've already decided that Schedule A, Schedule B, Schedule C, and Schedule D don't apply to us. So we're going to go right here, and let's just say that John Doe had $200,000 of qualified business income. And this would have been calculated. If it's 4 or more trades, then you would need to attach a statement. You may also need to complete Schedule C if there was any loss netting and carry forward that gets applied to calculating your qualified business income. In line 3, we're simply going to take this amount and multiply it by 20%. So we've got $40,000 here. Now, if your taxable income is $191,950 or less, that's for a single taxpayer, or double that for married couples filing jointly, then you can skip all the way to line 13. You would enter this amount on line 13. So this basically is asking you to calculate any reductions that may happen. Now we're going to go through this, the steps 4 through 12 anyway. So let's just pretend that we have to go through each of these steps. In line 4, we're going to enter the W-2 wages that were from the trade or business or the aggregation. So let's just say that John Doe's allocable share of W-2 wages, this would be his share of the W-2 wages. So let's just say that his share was $100,000, and the rest of the income went to maybe a partner. So in line 4, we've got $100,000. We're going to multiply that amount by 50%, so that gives us $50,000. In line 6, we're going to multiply that by 25%. And then in line 7, we're going to calculate the allocable share of the unadjusted basis immediately after acquisition for all qualified property. So this is also known as the UBIA. So in the form instructions, basically, it literally just says unadjusted basis immediately after you purchased all unqualified property. So there's not a lot of guidance in the instructions, but there is an additional note. So if the QBI on line 2 is 0, then the amount that's reported here must also be 0. In other words, if you have 0 income, you can't have any positive basis in your property. You have to have been able to write that off, because as long as you have income, it's if you have a loss or negative income, then it will reduce this income, and once this is gone, it will have impacted your basis as well. So so let's just say that the basis of everything is $50,000. At this point, it's not material what kind of business John is in. We've already determined that he's not in a specified service. So those are those limited fields, such as financial planning and all of these other service fields that have phase outs or application limits to the QBI deduction. In line 7, we're going to multiply that by 2.5%. So that gives us $1,250. Yeah, that sounds right. So we're going to add lines 6 and 8. We get $26,250. And in line 10, we're going to take the greater amount of either this or line 5. The line 5 happens to be the greater amount. And now we're going to enter the W-2 wage and the UBIA qualified property limitation. So we'll enter the smaller of either line 3 or line 10, which happens to be the $40,000. And now we're going to enter a phased in reduction, which would be amounts calculated on line 26. This would only apply to specified services. So this is the phased in reduction part that says if you're a specified service and you're above the the minimum phase-in threshold, but you're below the maximum phase-out threshold, then you may have a partial deduction that needs to be calculated. We'll do this separately, but because this is not a specified business, we're going to enter 0. There is no phased-in reduction. In line 13, we're going to enter the QBI deduction before any patron reduction. So we're actually not putting 0 here. We're going to leave this blank. And then the greater of line 11 or line 12 is going to be the $40,000. Patron reduction. This is another reduction based on certain rules that apply to horticultural or agricultural co-ops. Again, we did not check the box that said we're a patron, so we would not enter this amount at all. And then we're going to subtract line 13 or line 14 from line 13. 0 from 40,000 is still $40,000. And now we would take all the amounts from line 15 if we had 3 columns, and we would add them together. And if we had more than 3 columns, we would add all of those. So to recap, we're doing this singular calculation for each separate trade or business. And then from line 15 to line 16, we're going to report the total as the QBI component, the total qualified business income component. So this is the amount of QBI that goes to our calculation. I will circle back to part 3 because that is important to go over, but I'm not going to do it right now. I'm simply going to take the $40,000 figure, and we're going to work through the rest of this just to get a better understanding of how the QBI deduction is calculated from the actual QBI component. So we enter the line 16 amount on the line 27, and we're going to complete the rest of the calculations. So the first thing that we'll do on line 28 is we would enter any qualified REIT dividends and publicly traded partnership income or losses. If the amount is a loss, you would enter it as a net negative number, and any negative amount will get carried forward to the next year. So this carry forward doesn't affect the deductibility of the loss. It simply just gets carried forward. So for all intents purposes, let's just say that we don't play with REIT dividends or publicly traded partnerships. So we're going to enter 0 into line 28. We're also going to enter it into line 29, which is basically the loss carry forward from any prior years. So if you had a loss here, or if you had a loss from prior years, you would apply it here. In this case, we don't have any loss, so we don't have to worry about it. If you had a loss or the REIT dividend and publicly traded partnership income, if we did have any of that income, so we would multiply that by 20%. So I'm going to stop right here. I'm going to put in some fictional numbers. Let's just say we had $10,000 of REIT dividend income, and then we also had a $5,000 carry forward loss. So that would mean the total amount of income would be $5,000, and then we would calculate $1,000 by multiplying that amount by 20%. So we're simply calculating separately the amount of the QBI deduction before that limitation. So if there's the dividend or PTP component, we're going to add that to the line 27 amount. We've already got the line 27 amount locked in. We would just add any adjustments based on the REIT dividends or publicly traded partnerships. So now we're going to take a look at the taxable income before the QBI deduction, and that would be for line 33. This is how you would calculate it based on your Form 1040. According to the form instructions, you're going to take the line 11 amount from either your 1040, your 1040 SR, or your 1040 NR. Line 11 minus line 12. And So you take those two line items on the tax return, and let's just say that the taxable income before the QBI deduction was $100,000. We would enter any net capital gain that might have been increased by qualified dividends. And according to the instructions, that additional step that's required basically calls for us to enter the line 3A amount, which is the qualified dividends, not to be confused with the line 3B, which is the ordinary dividends, or generally total dividends. So you would take your qualified dividends plus the net capital gain. So if you don't have to file Schedule D, the net capital gain would be on line 7 of the Form 1040. If you do file Schedule D, then the net capital gain is usually smaller than either line 15 or line 16 of your Schedule D. If those are 0 or less, then you would simply just use your qualified dividends from line 3A. So let's just say that the total of all of that was $10,000 from our tax return. We're going to take that out, and that leaves us with $90,000 of income that we need to calculate the income limitation for. So this line 35 amount, we take 20% of that, and that's $18,000. So we're going to now take the qualified business income deduction before any domestic production activities deduction. That's under section 199AG. So we're going to take the smaller of either line 32 or line 36. So right now that's reduced down to $18,000. So before we go to the last three parts, what we've done is we've calculated what the QBI deduction could be, the total business income, qualified business income component. We added any REIT and publicly traded partnership dividends or income items. We now have applied a taxable income limitation calculation to that. And now we've got $18,000 of QBI deduction that we're now having to modify for any domestic production activities deduction. And so that would be under line 38. That is going to be whatever was allocated to you from an agricultural or a horticultural cooperative. So generally, there is nothing specific in the form instructions on this. You either have it or you don't. And most people probably don't. So we're going to enter 0. But if you did have something to report here, then you would be adding that to the QBI deduction. And then now you're going to combine the total REIT dividends and PTP loss carry forward. And to do that, you would combine lines 28 and 29. If this is 0 or greater, then this would be 0. So to go back to this, let's just say that we had $10,000 of dividends, but then we also had a $20,000 loss carry forward. We would then recalculate this to say we now have a $10,000 carry forward, right? And so that would be the carry forward figure that we use for next year's line 29. So if the reverse is true, we have more dividends than carry forward, then it simply offsets $10,000. This figure would be 0. So the line 39 amount goes onto your Form 1040 or 1040 SR, line 13. For 1040 in our filers, that would be line 13A. For the line 40, if the sum of lines 28 and 29 is negative, then you have to carry that forward to the following year. So let's go back to the portion where we phase in the reduction. So this is where we qualify for part of the deduction, but not all of it. And again, that is for companies that meet certain criteria, namely if you're not a qualified business, if you're a specified service trader business, and there's a lot of exceptions to that rule. For example, um, investment advisors are subject to this rule, but real estate professionals generally are not. Certain art related or accounting related activities are subject to this, but engineering firms are not. So, um, what we're going to do is we're just going to walk through this independently. So, let's say our line 3 amount was $100,000. Let me just make sure that that even makes sense. So, all right. So the line 3 amount is that amount, the QBI amount times 20%, and then let's say the line 10 amount is the lower of those, or sorry, it's the net kind of greater of all of these calculations. So let's say that that was $80,000. We're going to subtract this from line 17 and we get $20,000. Now we're going to go through taxable income before the QBI deduction. Let's just say that our income was, I'm going to make this easier for calculation purposes. We're going to say that the income was exactly $10,000 over the threshold of a single person. So we're going to enter the threshold. We've got $10,000 difference. We're going to enter the $50,000 phase-in range. And then we divide the 10,000 by the 50,000. I believe that gives us 20%, which means that our deduction is reduced by 20%. So we go back to line 19. This is the amount that we were eligible for. We're going to take 20% of that, and now we're going to subtract line 25 from line 17. So that means this $100,000, we're reducing this down to $96,000. We would enter this amount on line 12. So we would go back up to this, and that's where the phased-in reduction comes into play, right there, $96,000. Okay? So that covers all 4 parts of Form 8995A. This is the more complicated version. A lot of businesses may qualify for the streamlined version, the simplified computation. That's under IRS Form 8995. So we'll put links in the show notes as we're updating all of these resources. We'll put links in the show notes as they become available. So when this is all said and done, you should expect to see links to a full-length article, related articles on other forms that may be involved in the computation here, as well as the links to videos covering each of the schedules. So we'll be rolling those out over the next week or so. Please stay tuned. In the meanwhile, if you like our articles, I invite you to subscribe to our newsletter. You can do that from our website. There's also a subscription link in our show notes. If you like our YouTube videos, please subscribe to our YouTube video, to our YouTube channel. And as always, if you have any questions or comments, or if there's another topic that you'd like to see in an upcoming video, please hit me up in the comments section. Thank you very much and have a great day.